Hello, everybody, and welcome to some depreciation questions. So in 1993, Herman Moore completed the construction of a building at a cost of $2 million. It first occupied in January of 1994. It estimated that the building would have a useful life of 40 years and a salvage value of $60,000 at the end of that time. Early in 2004, an addition to the building was constructed at a cost of $500,000. At that time, it was estimated that the remaining life of the building would be originally estimated an additional 30 years, and the addition would have a life of 30 years and a salvage value of $20,000. In 2022, it is determined that the probable life of the building will extend to the end of 2053 or 20 years beyond the original estimate. So using the straight line method, compute the annual depreciation that would have been charged from 1994 to 2003. So let's take a look at that one first. So as you can see, I've been busy. Let's go through and take a look at this here. So I built the building for $2 million. So my acquisition cost is $2 million. My salvage value is $60,000. Okay, and it was going to last for 40 years. So my annual amount of depreciation expense is going to be $48,500. Now, when you depreciate a building, it has to be when you start using it. So we're not going to record anything in 1993. Rather, we're going to be starting in 1994. And because this is straight line, we're going to be going ahead and recording it as so. And so this is a question that I would have to give you the ability to use Excel, or else that would be cruel and unnecessary punishment. You'd have to really piss me off to do something like that, and your class is too cool for that, so don't worry about it. All right, so right over here, so again, so basically, so in, okay, how much depreciation would have been taken from 94 through 2003? So essentially it's going to be 48,500. That's going to be the amount that it would be charged from 94 through 2003. Now what they're asking is, what would the depreciation have been with the addition? So let's take a look at the addition. An addition to the building was constructed at a cost of $500,000. At that time, it was estimated that the remaining life of the building would, as originally estimated, additional 30 years and have a salvage value of $20,000. Okay, so right over here. So this is going to be $500,000. The salvage value is 20. And what you're noticing here is that we're putting in this addition in 2004, or year 11. And what you'll notice here is that this aligns with the original life. The original life was supposed to be 40 years. The building here is 30 years, so I don't really have to change anything with the building's original cost, or with the original estimate of the building. It's not extending the life at this point in time, it's just going through and adding on to it. So this is going to be 500,000. So this is 500,000 less 20,000. I'm dividing this by 30. So the amount of my depreciation on the addition, so we'll call this building addition. Okay, so starting here, the amount of the depreciation on the addition would be 16,000. So as I come down here, I'd be recording the same amount every year up until 2021, or Okay. So how much depreciation would be charged from 2004 to 2021? That answer would be $64,500. So come back over here. Prepare the entry if necessary to adjust the account balances because of the revision in the estimated life in 2022. And then what would the annual depreciation be beginning in 2022? So the first thing is, whenever we're changing the estimated useful life, we do not go back and change the numbers. It's only for errors that is not considered to be an error because it is an estimate. So what I've done here is it says here in 2022, it is determined that the probable life of the building and addition will extend to the end of 2053 or 20 years beyond the original estimate. And this here was at 40 years. So what you'll notice what I did is that I took over here of 2022 and here basically it ends up because 2022 is year 29. So it's essentially, this is a total of 60 years. So what I went through and did was I basically created this chart and I said to myself, okay, so the probable life of the building would extend to the end of 2053 or 20 years beyond the original estimate of 40 years. So what I've then have done is I've now said, okay, this thing is going to now last for 40 years or for a total of 60 years. So what I've done here is I basically have charted this out up until the date of change. So we're basically saying that this here is going to be our new estimate, right? Because we're really saying at this point, we've now determined that starting in 2022, it's now determined that the probable life will extend to the end of 2053. So what I'm going to need to do is to figure out how much depreciation have I taken up until this point, and then come up with new amounts for these two parts here. So the way I want to go through and do this is if I have a change in estimate, I'm going to go through first and figure out how much depreciation have I taken to date. Because I can't for like this 2 million, because I've already depreciated 1,358,000, I do not want to depreciate that again. So my original acquisition on the building was a total up here of 2 million. My depreciation to date is going to be 1,358,000 less the salvage value, which is going to be 60,000. So my depreciable base for the building is going to be $582,000. So that's the amount that I can go through and depreciate. So how long do I depreciate this for? Well, as it turns out, I was on year 28, so I've got another 32 years left. So remaining years, 32. So over here, when I go through and divide this, I get 18,187.50. Okay, so just to kind of see to make sure that this works, if I take this value here, and if I go through and I add all these up over here. Okay, so say if I take the total amount of depreciation expense, I get 1,940,000. That's a very important number because that's the most amount of depreciation that I can take because my salvage value is 60 grand. So that's how I would want to go through and check it. So in terms of the addition, my original acquisition cost on the addition was 500,000. The amount of depreciation that I've taken to date is 288. My salvage value for the addition was 20,000. So the amount that I can go through my depreciable base is going to be 192,000. My years remaining are going to be the same. And so the amount of my depreciation expense is going to be 6,000. So what I want to do, just to make sure that I'm doing this correctly, is I want to kind of do the same thing. And what I did was I basically took this total, added up all the new ones, and I'm getting over here 480. And again, that's an important number because that is the total amount that I can actually go through and depreciate for this one particular problem. Okay, so let's go through and make sure we answered all of our questions for this first part. There's no journal entry, and then the annual depreciation to be charged and beginning in 2022 would be the sum then of these two values here, or 24,187.50. Okay. Okay, for this next one, we've got the Greg Maddux company constructed. Very good pitcher, by the way. Played for the Braves, a little bit for the Dodgers. Constructed a building at a cost of $2.2 million and occupied it beginning in January of 2001. It was estimated at that time that its life would be 40 years with no salvage value. So in January of 2021, the new roof was installed at a cost of $300,000, and it was estimated that the building would have a useful life of 25 years from that date. The cost of the old roof was $160,000. So there's a couple different approaches we can use in this question, but let's go through over here. And, you know, what I want to do is that if they're telling me that that roof over here had a balance of $160,000, I'm going to kind of break that off. So building, no roof, building with old roof. That's basically old roof. Okay, so the building cost was $2.2 million. However, they're saying that the cost of the old roof, which is part of this cost, is $160,000. So what I'm going to do here is I'm going to say building with no roof is going to be 2.2 million minus 160,000, or 2,040,000, and the old roof is 160,000. Okay, so with these here, because they have no salvage value, you don't really have to worry about parlaying that out. So to determine the amount of the depreciation expense, what I'm going to do is I'm going to take each of these amounts and divide them by 40 years. Okay, so for the building without the roof, if I don't include the roof cost in there, this is going to be at 51,000. And then the old roof is over here at 4,000. So what does this look like? So I got a new roof in January of 2021. So what I'm going to do here is I'm going to go through and I'm going to depreciate this through 2020 or into 20 years. So the first question that I'm being asked is what amount of depreciation should have been taken, charged annually from 2001 to 2020. So over here, it's going to be $55,000 per year. Now, when I get over here and I'm replacing the old roof, what I need to do is I need to take that old roof off of my books. So here, my old roof had a carrying value of 160,000. At the same time, the accumulated depreciation on the old roof is going to be this 4,000 all the way through here, so a total of $80,000. So when I go through in this over here now, what I'm now going to do is, so I've got the accumulated depreciation of 80, old roof. And so over here, I'm going to have a loss on disposal of roof. And this is going to be $80,000. Okay, when I'm getting rid of the old roof. So again, that's why I'm kind of going through and treating this as a separate asset. Okay, so that's what I went through and I did. So now, if I look at this over here, I have a new roof. Okay, and my new roof had a cost of $300,000 and would have a useful life of 25 years from that date. So let's go through our questions. We've done A, we've done B, and then the other thing you would also do too is you'd say new roof. And then this would be a credit to cash, or excuse me, this was for 300,000. Okay. So there would be no entry to record. Oh, so you don't do any kind of revision. Rather, what you're doing now is you're charging what would the new depreciation be. So now what we're going to do here is that we've got two revisions. Because we put in a new roof, this is now going to be from, let's see here. So originally, okay, so originally this building was going to last us for 40 years. So this whole 51,000, it would have come down over here to 40 years, and that would have been that. If I took this and just kind of for fun, I'm going to have to erase this shortly, but if I did this here and I summed up these values all the way up here, the value that I should get as a result of doing this should be $2,040,000 because there was no salvage value. So what's happening here is that by putting on the new roof, I'm actually extending out the life of 25 years. So 25 years from this date. So I add the new roof on year 21. So there's going to be year, basically year 21, but it's going to be out 25 years from that date. So what I'm going to do here is I'm going to go through and then say, okay, it's now lasting me through 2045. So my new roof, if I said over here, so the building, new roof, this is 300,000. I divide this by 25. My annual depreciation on the new roof is going to be $12,000 per year. So this here is going to be on the new roof throughout here. And just to check my work, because I have no salvage value, when I add up all these amounts here, it needs to equal up to that balance of 300,000. However, when I have the regular building, this is a little bit different because now at this point, so my new depreciation, so my old cost without the roof was a total of $2,040,000. My depreciation to date was a total of 51,000 times 20, or here a total of $1,020,000. So my new base is going to be $1,020,000. What I'm going to do though, because when I put that new roof on, it's now lasting for 25 years. The new amount I'm depreciating this for is going to be $40,800. So starting in year 21, this is going to be $40,800. Okay, and I have to take Professor Kasoy's or Professor Mather's Excel class. Just point out this video to them when you do that. Okay, so when I add all of these up here, what I end up seeing is a total of $2,040,000. So I know I've done that right. So my depreciation that I'll be charging for 2021 is going to be 52,800. And just to kind of go through and to check my work, that's how I'm getting that response. So those are the answers for exercise 1113. So fun stuff. Look forward to seeing you on the next video. Have a great one, and I'll see you soon. Good night.